Hello, and welcome to this Grocer Vision masterclass on D2C and food and drink subscriptions. My name is Julia Glotz, and I'll be guiding you through our discussion today and putting your questions to our panelists. During the pandemic, direct-to-consumer selling became a real priority for many food and drink brands. With other sales channels suddenly closed, here was a channel that allowed you to stay open for business, build direct relationships with consumers, and get valuable shopper insight and data. And crucially, it wasn't just brands that became very keen on D2C. There was lots of consumer demand too. Take-up of D2C and subscriptions soared during the pandemic. In fact, by some accounts, more than a quarter of UK consumers are now signed up to a food and drink subscription box service of some description. But nearly 2 years on from those early days of lockdown, many brands are taking a long, hard look at their D2C operations and asking, is this still working for us? Are we seeing the right levels of return for our investment? And if D2C and subscriptions are in fact going to be part of our future long term, how do we maximize the opportunity and deliver what consumers want? To answer these questions and many more, I am joined by a panel of experts who live and breathe D2C. Their businesses have been focused on D2C and subscriptions for many years, and they're here to share with you what they have learned about making this business model a success. So from Oddbox, we're joined by Head of Growth, Liz Yates. Liz is focused on scaling Oddbox to be a profitable household brand while supporting the company's mission of fighting food waste. Prior to Oddbox, Liz was commercial marketing leader at companies including Sainsbury's, Groupon, and Google. We're also joined by Ollie Ashness, founder of SimplyCook. Ollie started SimplyCook back in 2013 with a mission to bring joy to mealtimes through fantastic flavor and simple recipes. Earlier this year, Ollie made quite a few headlines because he sold SimplyCook to Nestle in a deal that was widely hailed as a vote of confidence in D2C, but also the SimplyCook model in particular. And from Attest, we're joined by founder and CEO Jeremy King. Attest is a consumer insights platform that helps companies like Oddbox and SimplyCook use data to spot emerging shopper trends and grow without guesswork. Welcome, everyone, and let's get started. And Jeremy, I'd like to start with you, if I may. At Attest, you do lots of consumer research into D2C, and you recently published a report on the post-pandemic opportunity for D2C. Just give us a quick primer on where UK consumers are at when it comes to buying direct from brands. What drives them to do that? What drives them to sign up to a food and drink subscription? And what are they looking for from these kinds of services?
Yeah, I mean, the pandemic has been an amazing growth period for many D2C businesses, getting deliveries to your home, making those customizable, exploring new products. And when other channels are removed, suddenly D2C is tried by many consumers for the first time. In our research, what's actually really interesting is we get excited in D2C about things like unboxing, the physical opening of packages, about the purpose of brands, about the influence of social media. But what comes across in our research is it's actually the fundamentals, the really simple things that drive D2C adoption. Yeah, lots of people are trying D2C and subscription business for the first time, but in our research in the UK, the number one criteria for D2C selection from consumers across the UK is value for money. After that, ability to choose which products are sent, the customization, either specific product ranges or volumes of products. If I get to have a subscription for household detergent or cleaning products, the size of my house and the size of my family and how that changes over the year. Ability to customize that is really important. And after that, things like being easy to pause and cancel. These are the classics, the fundamentals of D2C, and these continue to be above everything what drives the success of great D2C businesses in a pre-post pandemic world.
Liz, I'd love to bring you here in on this. Does that resonate with what you're seeing in terms of what motivates customers to choose Oddbox as well? And have you seen any of those motivations change at all during the pandemic?
Yeah, I think that's a really good question. And actually, just on the pandemic point in particular, there's no doubt we saw a tremendous amount of organic growth following COVID. And this was something actually at Oddbox we were concerned, actually, have we just acquired a bunch of customers that were really using us as a temporary stopgap while it was challenging to get to supermarkets? So we did actually run an Attest survey over the summer this year to understand people's motivations for signing up to Oddbox. And actually, we were pleased to find that actually only 10% of consumers signed up to Oddbox for COVID convenience reasons. So we tend not to get too hung up on this segment or customer cohort. But what was really interesting for us is nearly half of our respondents actually said their primary reason for choosing Oddbox was for sustainability reasons. And that was followed by a third of people choosing, I would say, those kind of brilliant basics reasons that Jeremy just mentioned around value for money. And with Oddbox specifically, I think it's actually eating fresh fruit and veg and having a really varied diet was that core reason. I think what's interesting is actually sustainability has come out top, and actually this fresh fruit and veg has come out second. And we actually see the inverse of that with our performance marketing.
It's really interesting. And Ollie, can you just share what that looks like from a SimplyCook perspective? What are the factors that have been driving customer growth for you recently? And again, did you see any of those change during lockdown?
I think we felt a big effect from lockdowns, but possibly not the same effect as some other businesses in adjacent categories saw. So I think customers have always used SimplyCook to try new meals initially, and then oftentimes they get hooked on particular dishes, and they might cook those on repeat. But that initial customer need is to cook new meals, and we're sort of piggybacking on some market trends where people's interest in cooking more adventurous meals is on the rise, and we're in a sector that's growing. So we actually pick up 2/3 of our customers have churned from the major recipe box players like HelloFresh and Gusto, if you like. So we're in this sector that's growing, where interest in food is going up, but we actually look at everything on a micro level, really, rather than the trends. So most of our growth over time has come from building our internal growth marketing capabilities, focusing on the funnel, really, site conversion rates, activation rates, what we're doing in terms of testing in different marketing channels, and increasing our budgets over time. So our growth really has been about tapping into that job we do for customers, which is help them cook new meals, and then gradually increasing the marketing budgets over time in line with a market that's growing as a result of other people spending lots more money, really.
Got it.
And COVID for us was, marketing was cheaper, consumers were more interested. We had the same cohort fear that I think everyone had, like, are all these people going to disappear afterwards? I think for almost everyone that hasn't been the case. So it's just temporary, like marketing costs are a lot better, consumers are a bit more interested, and they've all stuck. So net pretty positive.
Fantastic. Now, while we're just establishing some of the fundamentals around D2C, I want to quickly bring in our first audience question here. Fred Lennox Cunningham, account manager at Osborne Pike, asks, some categories such as craft beer and loo paper seem to lend themselves more to D2C, while many others don't seem to. Is there a key factor? And if so, what is it? Jeremy, could I just ask you to briefly explain what makes a category suitable or unsuitable for D2C? It used to be that people talked about whether it fits through a letterbox, but it's obviously a little more complex these days. Can you just break down what makes a category suitable?
Yeah, I mean, it often depends what's in the box, but a lot of our research shows that how you deliver, the level of flexibility, price points, all of these different fundamental drivers are really what's important, and that will dictate your success almost more than what's inside the actual subscription box or service delivery. I think the reason that certain categories succeed or fail is when there's a reason for those companies to exist. Is this service subscription better for the customer, or is it a better business model for the company? And a few of these we've already heard about. Better for the customer, with beer, it's about ranging and selection. If you go to your local Tesco, there aren't that many beers there. A subscription service can bring in a whole bunch of inventory, break the bulk, and deliver you a whole bunch of beers you've never seen before. And that level of sort of intrigue, but also availability, subscription model actually works really well for that ranging and availability problem. Toilet paper is about convenience, where you had Liz at Oddbox mentioning sustainability. Flexibility is really important, so that subscriptions remind you to use a consumable product, but also change with your consumption behaviors over time. But whenever there's a reason a subscription product is better for consumers, that's a great reason for it to exist in a category. On the other hand, sometimes a subscription model is better for a company. That can be because you have a better product, but you don't want to compromise which channels you sell it through. There might be better economics for the company. If you run a subscription model, you have more control of your supply chain, of your price points, of exactly how you can vary those things over time. You are less beholden to channels. So better product of economics. And last bit, better data. That data is coming back to us, the subscription companies, and put those two things together. Subscription products can be better for the company. And if you can combine those with the reasons are better for consumers, that's what really unlocks a specific category or product with a subscription model attached to it.
And by extension, are they key factors that make particular brands in a category either well suited or not well suited to D2C? And Ollie, I just wonder if a brand founder is watching this and they've perhaps dabbled in D2C a little bit, but they're now wondering if they have what it takes to succeed. What would you advise them to look at internally?
Well, I think it's really easy to answer these days. So you could probably, I think it's realistic if you had a completely new concept now, if we came up with one now, we could go away, build a landing page, point some Facebook ads at it, point some Google traffic at it, put a buy button on there that doesn't work. And we could have a proxy metric for what a CPA might look like for a new product, probably within 4 hours if our lives depended on it. And also, I think, while I've been running SimplyCook, and before that I spent a couple of years in venture, I've looked at businesses that I really didn't think would work as a direct-to-consumer business that have, and I've looked at businesses that I thought would work well and haven't. So I'd encourage people to... I've also spoken to a lot of founders who I've sort of said, well, you could find out really quickly, and they haven't. So I think the hard thing to do is actually put yourself out there and spin something up and say, right, Shopify site, let's build one this week. Let's see if people buy this thing or a minimum viable version of this thing or something that looks like the thing I want to sell, and find out quite quickly. The really hard thing is looking at those early metrics and going, well, what do these mean? And I think that will remain hard for quite a long time after you do those first initial tests. So I think speaking of other businesses, there's a really, really successful direct-to-consumer subscription business that's probably doing 100 million revenue now, where I know the founder was very close to canning it because he didn't think the metrics were going to get there. And they massively improved their retention. It changed. I've also seen businesses where I've thought, wow, your metrics are really good. And they sort of threw, as far as I can tell, threw the towel in and didn't think they were going to get there. So I think it's really easy to try something. It's actually quite hard to know what good looks like, even if you know what you're looking for. So, really experienced founders sometimes, clearly get that wrong too. So that would be my advice. Just get out there and see what happens.
Just get out there and see what happens. Liz, what about you? What questions would you recommend brands and founders ask to figure out if they are potentially a good fit for D2C?
Yeah, I think I'd echo a lot of the points actually that have just been made. I think like testing, anything you can do to simulate a real world situation is going to give you the most accurate view on whether it's going to be successful or not. And I agree with a lot of the points as well Jeremy was making. I mean, I think I'd be asking myself, what are the core benefits of direct to consumer? And essentially what that means is you're not just owning the products you're selling, but you're owning the shopping experience. And the core benefit of that is really that, you do have total control. So if I'm operating in a category where the shopping experience is particularly frustrating or challenging, whether it's because it's sort of boring and maybe repetitive if you're a functional product, or whether it's just very overwhelming because there's so much choice if you're in like cosmetics or alcohol, what can you do? Is there an opportunity there to turn something which is a negative for consumers and build an experience around it? Similarly, if you're a purpose-driven brand like Oddbox, we only distribute through our site. And part of that reason is because we do want to have that end-to-end control. It's very important to our mission. I think also thinking about things like how competitive the landscape is that you're operating in. If you succeed in building a high quality shopping experience, that's very difficult for other businesses to replicate. So it can be a real point of differentiation. And then also, I think Jeremy touched upon this, but margins as well. We know they're fairly tight in food and drink. If you're not selling through a third party, it does help with your margins, and that's going to be increasingly important in the next couple of years with labour shortages, Brexit costs. So these are the types of questions I'd be asking myself. I think the other additional points, maybe the watch outs, would be that you are very reliant on driving that traffic yourself. So you do have to have a really clear growth strategy. And I think the other big one is ultimately, if you're certain that it is going to work for you and you have gone through this process of testing, when you're actually building the real deal, you know, it is a significant upfront investment. And it's going to be a while until you see the paybacks from that. So, you know, how are you going to fund that, and can you wait to see those returns?
Fantastic. And I think we'll get an opportunity to actually go into a little bit more detail on some of the points you raised there, including how to drive traffic a little later on in the discussion. But I just want to bring in our next audience question here. Anton Pozager from Quaz Drinks asks, is a D2C strategy without a subscription option destined to fail? And Liz, actually, I'm going to stay with you on this because subscriptions are central to the Oddbox model. But do you think for an FMCG brand looking at D2C options, can they make it work without subscription, or does that need to be part of the offer today?
I think the short answer is it doesn't necessarily need to be part of the offer. But if I look at the majority of FMCG brands, you know, they're low price points, they're fairly standardized products, and they've got a really high repeat purchase rate. And so to some extent, it is a bit of a no-brainer. I think the point at which it actually does become necessary, like you absolutely have to have the subscription model, it really comes down to your range. So I think a really good example would be like Who Gives a Crap, paper, Small do cleaning products. They started with laundry detergents. Even Oddbox, we actually only have 9 SKUs. And so for businesses where you've got a really restricted range and you're not going to be able, or, you know, there's only so far you can drive AOV, I actually do think it's critical that you have to help you with that retention and lifetime value. I think the opposite end of the scale would be for FMCG products where it's not quite as binary as to whether or not that product is really essential and a need versus a want. And perhaps, again, Jeremy touched upon this, but categories where there's a really broad range of choice. I think those types of products where you have a really big range yourself, I don't think you need a subscription model. And I think a really good example would be a northern-based business called Beauty Bay, who sell cosmetics. They've got over 12,000 SKUs on their site, and they don't have a subscription model because they're able to drive that AOV. Doesn't mean that repeat purchase isn't a challenge for them, but it means that the economics do work without one.
And Jeremy, what's your take from what you're seeing across the market? Is a subscription option something that the FMCG brands doing D2C really need to look at and need to offer today, or can they still make it work without?
Well, I think it's important to think about why why businesses like subscription models. It creates convenience and habits for consumers, but the kind of dirty phrase investors and businesses trying to get into direct-to-consumer use is revenue quality, very high revenue quality. You have a specific stream of revenue coming in. It's very predictable. You can measure it. You can understand the cohorts, and maybe it expands with order value over time. And it's very easy to value, and it's very sustainable. And if you launch a business that has this revenue quality attached to it, it's a very attractive one to launch. There's also very specific reasons why, as a supplier, you might want to have a subscription model. If for Oddbox, for example, we have perishable products. If you want to set up a large supply chain, you need consumption to attach to that supply chain. And those are two really good reasons why subscription products should exist and why you would want to have a subscription model attached. Then again, just this week, we had the Spanx IPO. They sell their own products on their website. They don't really have a very prevalent subscription model. They are doing just fine selling to Blackstone for multi-billion dollars. You don't need to have a subscription model, but sometimes there are reasons, and data reasons, investment reasons, economic reasons, or supply chain reasons to drive you down that path. But you don't have to have subscription models to succeed. It's more about understanding what consumers want. And it's possible to recreate that subscription type experience for your consumers. All subscription does is just pre-commit or remind users they need to receive your product. If you can do that through great marketing, great email campaigns, great brand loyalty, word of mouth referrals, there are different ways to create that same habit without forcing a subscription model onto consumers if it doesn't suit them. So all paths exist. Making the right choice, to Ollie's point earlier, will be driven by those consumers and the data that they tell you.
Fantastic. Now I'm going to take us away from the nitty-gritty of subscriptions for just a moment and return to look at some of the fundamentals that brands need to get right to succeed with D2C. Liz, on a day-to-day basis, what are the fundamentals that you are focused on getting right at Oddbox? And what would you therefore recommend brands looking to go into D2C focus on?
Yeah, I think for us at Oddbox, there are three things that we do really well that we focus on, and they are measurement, being very consistent with our brand comms, and having exceptional customer service. So measurement, sitting with my growth marketing hat on, I think Ollie made the point earlier, you're having to constantly iterate, whether it's your on-site conversion rate tests or whether it's different ad formats that you're using across different channels. And if you don't have a very clear measurement framework, if you forget to have a control group for an ad that you're running, ultimately it's been a waste of time because you don't really know whether it's worked or not. So I think being very clear about what the KPIs are that are your key lead indicators so you can act quickly, and having that framework in place is really critical to success. On the consistent brand messaging, I think that's particularly important for purpose-driven brands. I think taking a very broad view of brands, so it's not just marketing comms, it's everything from the creative and copy you see on the website to what you get in the box, through to the way that our customer happiness team speak to colleagues, is really important for building trust and authenticity. And then I think exceptional customer service. Inevitably, when you own the end-to-end process, when delivery is involved, when you've got perishable products, occasionally things happen, which means, unfortunately, people might not get their box. We just launched in the north at the beginning of September during a petrol crisis and a lorry driver shortage. And I think, if you've got an incredibly strong customer service team, and actually you can preempt some of those issues and get ahead of it, actually you can turn something that's a really negative situation into an incredibly positive situation. And actually another brand that I've seen do that incredibly well is Bloom and Wild. They have an amazing customer service team. So yeah, I think for me, those are the three core things that we focus on at Oddbox.
And Ollie, I mentioned in the introduction, you have just sold your business to Nestlé in a high-profile deal. Can you just take us behind the scenes for a moment? How did that deal come about? And what was it about SimplyCook and your model that ultimately proved so attractive to Nestlé? So, for example, I'm wondering about the fact that you're multi-channel, you're D2C, but you also have a presence in supermarkets. To what extent did that play a role, for example?
Sure. So how it came about. So I think we're talking the end of the first lockdown or summer 2020. We were basically looking at our fundraising options really, and speaking to a couple of advisors who pretty quickly said everyone in private equity is being really careful with their pounds because they don't know what's going to happen, but strategics would be extremely interested. And I think aligning that with my ambition to make SimplyCook as global as it can be and to touch as many millions of lives as we possibly can, meant that we sort of quickly lasered in on the strategic route as being probably the quickest way to tens of millions of customers globally. And also, candidly, at that very specific point in time, private equity were supposedly being so careful that we just thought, let's not waste our time there. We'd have to wait months. So we were looking at either raising some debt or a strategic deal as our two options really. And yeah, I think Nestlé were by far the most aligned of the strategic people we're speaking to in terms of their growth ambitions for the business, wanting to take it global. And that ties in with why they bought us as well, because I think they are interested. I mean, we're quite small for them. We're a small acquisition for them for sure, but they're interested in us adding ultimately tens of millions per year to revenue. And if they can buy a number of businesses that do that sort of thing, then across those businesses that can move the dial for them. Because, you know, I don't actually know, Jeremy probably does, but Nestlé probably grow at 3 or 4% a year or something like that. And so if they can find businesses that can grow at 50 or 60, and we're talking meaningful numbers where it's tens of millions, then that works for them. That isn't their only criteria. Obviously, I suppose they have to be interested in the sector. And the sector we're in, they are interested in the UK. They're interested in growing their UK food footprint, and we're very high margin too. So I think in the sort of broader direct to consumer food space, we are particularly high margin, and so particularly when we integrate more with Nestlé, the margins will be crazy high, and so they have very, very high confidence that we will be very, very profitable for them at scale. So they were the main drivers as far as I know. The big one being, can you add tens of millions to our P&L per year over the next 10 years is the main thing.
And Jeremy, Nestlé, of course, is far from the only FMCG giant looking to get more into D2C. Unilever, very well known for being active in this area. Kraft Heinz recently, again, being very active in this area, launching an eBay store to sell product bundles here in the UK. And there are many, many more examples. Ollie's already talked about what is driving this interest for some of these big companies, particularly from a Nestlé perspective. But can you just, again, give us an overview of why this is an area that those big FMCG players are really interested in? And by extension, what lessons should brands therefore take from this and apply to their own D2C efforts?
Yeah, probably 3 points to make here. One, these large companies are getting attacked by smaller players. They're entering spaces. Consumers are changing habits, and smaller attackers with D2C business models are taking on that consumption for the first time. They're either expanding the market to new forms of consumption with new products and new business models, or they're taking it away from those FMCG companies. But a big part of the stimulus is that there are smaller attackers who are entering these spaces that large FMCGs have dominated for a long time, and they don't like it. A classic response is to create an autonomous business unit, to create a unit that fights back, that can compete on the same terms, and almost to take that business model and figure out how they can do it with the advantages of being a bigger player. player. The key is that smaller players have more agility. They have different forms of capital. They have different return expectations. They have different risk profiles. And that means it is quite easy to attack these big incumbents who tend to be slower moving. The big incumbents, of course, have lots of data, lots of history, lots of analytics, and those are the things that small guys don't have. So it's interesting to see in each category, in each consumer segment, in each market, how that trend plays out and where the balance lies. I think beyond that second point, the DTC business model gives big FMCG companies a new way to innovate and create new brands. It used to be that a brand was something you'd create over generations. You would manufacture it in a lab and perfect it and hone the emotional messaging. Now, FMCG companies can act a lot more like pharma companies, pharmaceutical companies. You can create a brand in a day. You can launch it quite quickly. If it fails, the costs are low. You can attempt it many times. This is kind of a form of competition and weaponry that the DTC business model offers, and that's attractive for FMCGs to experiment, ways to compete with those small people, to launch new ideas, and if it doesn't work out, move on and try a different version. That's quite convenient. We haven't seen the thing that everyone predicted with Unilever using the Dollar Shave Club model to expand that into everything they do. That hasn't happened yet, but what we have seen is spinning up a whole bunch of different brands and just seeing what works and what flies, and that's a very different way for those FMCGs to innovate. I think the last point is to consider who are the net losers here. So we have FMCGs that are used to selling through big retailers and building these large, iconic, global, ubiquitous brands. So the net losers are those ubiquitous brands. Different generations have different needs, and you could say that some of those brands are failing in younger generations and when consumption patterns are changing. DTC helps FMCGs replace that. I think the other losers are the retail channels. Does DTC expand the market, or is there some substitution? And that's different again for each category, for each demographic, for each market. And understanding how that's changing, why it's going on, that will dictate success both for small DTC attackers and for the FMCG incumbents who are trying to adopt this model for the first time.
And all three of you have at various points talked about the importance of data and consumer insight, particularly at a time when shopper behavior is changing quite quickly. How should brands then make best use of consumer insight and data to drive growth, but also to identify which areas, which customers, etc., to focus on? And Jeremy, I wonder if you could just talk a little bit about how your data can help brands that are trying to figure out how to take their next steps in D2C.
Yeah, we believe at Attest that for every consumer question, your target customers hold the answers, and we exist to just make it very easy to ask them and to find out what they want, why they're making the choices, what's changing, what's different this year versus last year, and what success looks like. Your target customers hold the choices and the destiny of your business, and we just make it easy to understand what that is and ask them. I think the key here is to never guess or assume what your target customers want or feel, and to constantly be looking for what's changing, what's new, why are they choosing this competitor, if we launch this product in this part of the world, what would people think about it, what's wrong with this before we launch it. And the key is to constantly do that as a habit. I remember sitting in Harvard Business School listening to the people who were launching the business that became Birchbox. And I sat there thinking, who will buy this thing? Little tiny samples that come in a wooden box, and you pay for that to come to your door, and then you might buy some of those products. And you're also telling us that the producers of the beauty products will pay to be in the box, and you're going to make money at both ends. This makes absolutely no sense. This thing's going to die. I was not the target customer, completely wrong. Understanding that target customer is the key to success, and that's a constantly moving target, will always change. And with each of your decisions, understanding what your target customers want will dictate what your success is. So constantly looking at the data and figuring out where to go next is the most important thing you can do to win.
And Liz, right at the start, you talked a bit about how you actually ran a survey with Attest during lockdown to just double check that you were getting the right read on what was happening with customers and with shopper behavior more generally. Can you talk a bit about how you tend to use data from Attest to inform your strategy more generally? When would you go to Jeremy's team and say, we have a question here that we need your help figuring out?
Yeah, all the time. So we use it right through the entire marketing and product life cycle of activity. So from trying to understand and predict future behaviours from a forecasting point of view, so we touched upon the churn survey we ran over the summer, diagnosing existing customer issues. So I think one of the best features of Attest is you can actually use it to reach your existing customer base and you don't pay for those surveys. We constantly see behaviours like over the summer, loads of customers were skipping boxes. What we didn't understand without running a survey from Attest was, are they skipping because they're on holiday? In which case, there's really not much we can do about that. Or actually, are they using that skip function to control their order because they're getting too many items in their boxes and they're not getting through it? In which case, that is something we need to tackle. I would say we use it as well for validating messaging, creative and MPD. So we ran a recent out of home campaign. All of our copy lines were tested. So we had real conviction in our creative route moving forward. So really important if you're spending a lot on media. And then finally, we also use it to actually track the impact of those activities. So we set our brand tracker live last week. Within a day, it's complete. We've already got the results and we've got a much fuller picture of the impact of like that out of home activity. So yeah, we use it a lot.
And Ollie, what does that look like at SimplyCook? When would you go to Attest and what sort of questions do you typically ask them to explore for you?
We've looked for competitor intelligence. We've looked for some guidance on brand awareness, how our brand awareness is growing, to try and correlate that with some of our internal data. I think our outlook on data in general, so we have heaps, and I think that the ways in which we could query it are effectively infinite. We could continue to ask questions all day. So we spend probably a disproportionate amount of time making sure we're asking the right question first. And that's the hard bit. I think getting the right question is much harder and much more important. And once you've got that bit right, it's quite easy afterwards.
And are there any questions you've been asking recently that you could share with us?
Of our own data. I mean, I suppose constantly. Embarrassingly, we found out yesterday that we're pushing customers who are reactivating their subscriptions through a 2-year-old funnel that forces everyone onto a fortnightly subscription against their will. And we didn't know. It just sort of popped out in a piece of data that we're sending more of these emails on Mondays, and every Monday there's a ridiculous number of customers signing up on fortnightly who should be reactivating on the frequency they were on before. And no customer has told us this. It's been happening for months. But yeah, so I mean, there's constantly things coming out of the data internally.
And Liz, the job description I read out for you at the start mentions that you're focused on growing Oddbox profitably. And I think that emphasis on profitable growth is essential in a DTC context, isn't it? Because I think brands have learned that they can actually get themselves a decent amount of growth, but not necessarily on profitable terms. And a really big part of making that growth profitable is the ability to drive traffic effectively and efficiently and keep your customer acquisition costs down. And you won't be surprised to hear that we have a few audience questions around that. So John Marlowe, sales director at Divine Chocolate, asks, what's the best way to drive traffic to your D2C site? Social, Google AdWords, mail outs. Liz, you mentioned you've started doing out of home in a much bigger way. Tell us about what you're doing with out of home and also just generally what you have learned in terms of driving traffic profitably and effectively.
Yeah. So what I would say is, starting on the profitable question. So at Oddbox, we have actually had a funding round recently, but there was always a very strong focus on actually getting the business to be profitable. And it's not growth at all costs. So our North Star metric in the growth team is the lifetime value to CPA ratio. And, you know, sometimes we always aim to have a 4-to-1 ratio. Sometimes we're really successful and we get it up to 7-to-1. Sometimes it's not looking so good and it's more like a 3-to-1. But in terms of how we drive that, I think it's about unpacking that metric and understanding that for driving lifetime value, the acquisition team actually have a really big role to play, and your media mix has a really significant impact on your retention, as does your offer mix. So we try and set our CPAs based on a channel level, based on the lifetime value of those channels. I think the other thing is that we do have a separate life cycle team that are very much focused on retention, frequency and AOV. And we know that that is a longer term play, and we're sort of realistic about that. They're working on bigger bets and more product orientated features. And then I think, you know, on the profitability piece, we're very cautious to sort of make sure we always have a very forward-looking view and we kind of know what's coming down the track. So something we're thinking about a lot at the moment is obviously the downward pressure on margin in the coming year from, you know, labour shortages, Brexit costs. And so I'm already starting to think about things like, okay, well, how can I make my media even more efficient, which I think is what you always think about in the growth team. But also, you know, do we need to do some research around price elasticity with our consumers? Because potentially, we're not saying it is going to happen, but if we need to make a decision on that, you need to understand where your consumers' heads are at. So that's kind of, I suppose, our approach to profitability. In terms of the out-of-home question, the reason why that came about is, I think in like a scale-up business, you're always trying to balance the need to bring in revenue in the short term versus working on media channels that you know are a longer-term play. And the out-of-home actually came about off the back of our Q2 brand tracker survey with Attest, where actually we were quite surprised to see that in our core market of London, we have really high brand awareness for quite a young brand. But actually, for the people that had heard of Oddbox, people, even those customers, or sorry, prospects, were more likely to think that HelloFresh was an eco brand, or to select HelloFresh as an eco brand versus Oddbox. And so we realized that we probably did need to look at really doubling down on our eco messaging and really leaning into that. And actually that we needed to experiment with more upper funnel channels, and particularly formats where we could tell more of our brand story. So actually that's where the inspiration for Out of Home came from. Why we chose it, again, relevancy. People are more likely to be out post lockdown, sort of pounding the streets of London. It's quite cost effective. It's quite quick to execute, and actually you can get a through the funnel comms plan through different formats. So we use cross tracks to tell our brand story, bus stop ads to drive frequency, tube card panels to drive conversion. We're very careful about our creative testing, used Attest for that as well. And ultimately, I've run out of home campaigns before with previous brands, and I have to say I haven't had much success. But actually, within the first 2 weeks of our out-of-home ads going live, we had a 60% incremental uplift in sign-ups versus our control region. So we're really happy with the results. But I think it was just the careful media planning and creative testing that we really got there.
Fantastic. And Ollie, just to go back to the options that John at Divine Chocolate is asking about specifically. So he wants to know, you know, out of social, Google AdWords, mail outs, possibly other options, what's the best way to drive traffic? And I know the answer here isn't going to be the same for every brand, but you've obviously also done TV advertising. Can you just talk a little bit about what you have learned about how best to drive traffic?
Sure. So, I mean, it would be great if search were the answer. So I'd quite like to run a business where it's just entirely driven by loads of search traffic and it's really straightforward. I think that was probably, 10, 15 years ago when everyone who searched for tracksuit bottoms landed on ASOS and that sort of thing. So I think that's probably largely been and gone. I think but it depends what your product's like, right? So if you have a product people naturally search for, then it will naturally be built by search. I think most businesses tend to find one or two, preferably two, but two channels that work really well. and the rest, they sort of build a strategy around those channels. I think for a business like SimplyCook, people sort of need to discover it. It's as I say, it's not something they search for. So Facebook's a natural fit in terms of browsing around, not really looking for anything in particular. You interrupt their journey, you showcase them something new that piques their interest. So, and I think Facebook and TV can both do that. So yeah, I think for discovery, Facebook is really good. Like, the costs are going up really quickly. It's not getting easier. Nobody knows how many customers they're getting through Facebook at the moment with the platform changes. Definitely not even Facebook. So it's a bit messy at the moment, but it's a really good place to help people discover a product and get testing. TV, I think you have to place quite a big bet. You know, not enormous, but it's pretty significant. You probably want to be spending in the hundreds to do a small test across creative and media. So our cost to get someone to activate their subscription is pretty much the same on TV as it is on Facebook now. And that is not a COVID adjusted TV number when nobody was buying any TV last year. That's this year. So it actually is sort of, for us, it's very similar. And they're our main two volume drivers, but they're way more expensive than affiliates and partners and referral, etc. So you probably want to do some channel testing to find out, because I won't know the answer for different people's businesses. Facebook's probably a good place to start, but then making sure you've got the lower cost stuff around, you know, referral and incentivizing that as heavily as you can, probably initially. And some affiliate and partner campaigns to get moving to keep costs down, I'd say would be a good place to start.
Fantastic. Now, we are nearly out of time, but before we finish, I want to return to the bigger picture and the post-pandemic opportunity for D2C. And I just wonder if you could each articulate in a couple of sentences what you think the biggest opportunity is for D2C in the new normal, and one key thing that FMCG brands should focus on to make the most of that opportunity. Jeremy, what would you say?
So I think the biggest opportunity is in using the sheer advantages of the D2C business model to create advantages for customers. D2C gives us so much flexibility, so much data. It allows much more rapid innovation. So to apply those advantages and use it to create new things that suit consumers, things like flexibility, things like the ability to skip or pause or change the volume in your deliveries, things like how you interact with D2C companies. A whole bunch of people in our recent research want to interact with D2C companies and their subscriptions in ways that suit them, like WhatsApp. And then last point, being very honest about reasons why people should join your subscription or D2C business, but also reasons why people don't like it. If you never acquire those customers, you will never serve them, you will never lose them, you'll never pay to get them, you will never have to support them. So actually being more upfront about why people should love your product and also why people don't love your product is actually going to play in your favor. So these are some of the material and structural advantages of being a D2C company, and using those and applying those to modern consumption. That's the key. I think the one bit of advice I'd say is to constantly seek what your target customers want and to understand that as often as you can. Even brands like Peloton get this wrong. They launch TV campaigns that are branded sexist by millions of people, and it wipes billions of dollars off of their market cap overnight. If only they'd asked 100 people outside of their own office building, they would have known that before they committed huge amounts of dollars and capital to completely screwing that up. So find out as much as you can about your target customers, because at the end of the day, that's what will dictate your success.
Fantastic. And Liz, what would you say is the biggest opportunity for D2C post-pandemic, and one key thing FMCG brands need to focus on to maximize that opportunity?
Yeah, I think historically there's always been a perception that D2C brands are for younger generations. And actually, I think the one thing that the pandemic's really changed is, everybody to some extent has moved to online shopping. So I think if you're an existing D2C brand that perhaps has younger audiences, I think especially post iOS 14 and the Facebook challenges, if you're having to look at more traditional media channels, I think there's an opportunity to investigate how you can better serve older audiences and capitalize upon that opportunity. And I guess the inverse from that is if you're an FMCG brand thinking about direct to consumer, maybe you have an older customer base already. Actually, maybe there's a real opportunity there to serve them in a better way. And, perhaps this could be a new competitive advantage for you.
Fantastic. And Ollie, your take on this, biggest opportunity for D2C in the new normal and how to make the most of that opportunity for FMCG brands?
Yeah. So, I mean, I don't think it's going to get loads easier. I think there's loads more money flowing in and big players getting more and more interested. I think there'll be a lot of opportunities in pockets of niches with different preference sets. So if you can find a, slightly higher value product with, and there's a niche customer group that go after that, there'll be lots of opportunities to build smaller businesses there. I think speaking more broadly, moving outside of the UK, I think, internet penetration is really high here and COVID's just happened. So we're kind of, 4 years ahead. And, I think Royal Mail parcel sales have massively contracted or something in the last 3 months. So it's kind of short term in reverse. But whereas emerging markets, I think, are absolutely bonkers. So if I was setting up a direct consumer business tomorrow, I'd either pick a niche or I'd pick a business that I could obviously internationalize into emerging markets where they're going to go through that e-commerce penetration growth we've gone through.
Fantastic. Now, I'm afraid we're out of time. I think we could have easily kept going for another 45 minutes, but we must bring it to a close. Thank you so much for joining us and for asking such interesting questions. There are further materials for you to download from the webinar panel, including that D2C report that Jeremy mentioned right at the start, which is full of useful data and insights. So make sure you download that before you leave. But all that's left for me to say is a big thank you to our panelists, Liz Yates from Oddbox, Ollie Ashness from SimplyCook, and Jeremy King from Attest. And thank you. Goodbye.